So it's a nice time we meet again for a session of advanced financial reporting. So for today, we are going to do a question of May 2015, that is under advanced financial reporting. And this question concerns external reconstruction, that is under May 2015 question 3. So let us go through the question so that we see what they required us to do. Then we present those requirements. So on this scenario, on this case, they say that Tab Limited, a manufacturing company, started experiencing recurrent annual trading losses 3 years ago. Both the shareholders and the debenture holders of the company have accepted a reconstruction of the company by forming a new company to be named Fanaka Limited to take over the assets and liabilities of Tabu Limited. So you can see Tabu was the one which was experiencing recurrent annual trading losses 3 years ago. So both the shareholders and the debenture holders of the company have accepted to a reconstruction of the company by forming a new company to be named Fanaka Limited to take over the assets and liabilities of Tabu Limited. So the statement of financial position of Tabu, remember Tabu is the one which was under financial distress. So you are given its statement. So you don't have to read because you know it's assets and liabilities which are given there. So the next thing you have to go through is the additional information. They have said that Fanaka Limited, that is additional information number 1. Fanaka Limited was formed with an authorized share capital of 750 million ordinary shares of shillings 10 each. So this one means that these are the shares which Fanaka was having, which it can issue. So those are the authorized share capital. So each share, you can issue each share at shillings 10. So the total shares he was having, that is to be more specific, the ordinary shares was 750, of which you can sell those shares at shillings 10 per share. So under, before even I continue reading, under external reconstruction, you know that the main thing which is done is concerning a new company is taking over the operations of the old entity. Like now here, Fanaka was taking over the operations of Tabu. So Fanaka is taking over Tabu. That is the case. So Fanaka Limited is taking over Tabu. So Tabu will lose its legal identity to Fanaka. So obviously the first thing we always do is the determination of purchase consideration. And this purchase consideration is concerning how the new company will be paying the providers of capital in the old company. So that is mostly that is what they have provided in the narration. How the new company was paying the providers of capital in the old company. Like now, number 2, they said that the ordinary shareholders of Tabu received the 3 ordinary shares in Fanaka for every 5 shares in Tabu Limited. So the shares from Fanaka were credited at shilling 6 paid each. So the shareholders were to pay cash to Fanaka to make the shares fully paid immediately on the receipt of the shares. On the receipt of the shares. So number 3, the 10% preference shareholders of Tabu received 4 ordinary shares in Fanaka for every 5 preference shares in Tabu Limited. So the ordinary shares from Fanaka were credited at shillings 8 paid each, and the shareholders were to pay cash to Fanaka to make the shares fully paid immediately on the receipt of the shares. Dividends of the 10% preference shares were 4 years in arrears. As at 30 April 2015, Fanaka accepted to settle the amount due by issuing 2 fully paid ordinary shares and shillings 106% of every 2,000 of the dividends arrears. The debenture holders accepted 25 ordinary shares for every 500 of the debenture, the shares being credited at 8 each. So the debenture holders were to pay cash to Fanaka Limited to make the shares fully paid on the receipt of the shares. So the assets of Tabu were transferred to Fanaka at the following values. So the assets of Tabu were transferred to the new company, that is Fanaka, at the following values. Number 7, Fanaka Limited paid 75 million to Tabu to pay for the dissolution cost. The amount is to be treated as a preliminary expense and is to be written off against profits in the following 3 years. Immediately after acquiring Tabu Limited, Fanaka purchased trading stock worth 150 in cash and settled 125 million of the trade payables. All of the transactions were completed on 30th April 2015. You are required to do necessary accounts to close the books of Tabu, journal entries in the books of Fanaka, and the opening statement of financial position. So before we do the first requirement, we have first to do the determination of purchase consideration. So we have to do the determination of purchase consideration here. How Fanaka was compensating. So how Fanaka was compensating the providers of capital in Tabu. And that is what they have narrated in most of those additional informations. So this is a May 2015 question. So this is all about question 3. So May 2015, question 3. So what we determine first is the purchase consideration. So that is the purchase consideration. So the purchase consideration concerning on how Fanaka was paying the providers of capital in Tabu. So they started by giving you the authorized share capital. They started by providing the authorized share capital. They started by giving you the authorized share capital. And then number 2, they say the ordinary shareholders of Tabu. Remember that Tabu is the one who is settled, the one who are paid. So they give you that the ordinary shareholders in Tabu received 3 ordinary shares in Fanaka for every 5 shares in Tabu. So on this scenario, you can see that the ordinary shareholders of Tabu, Tabu were receiving what? Ordinary shares. They were receiving ordinary shares. They were receiving ordinary shares. So you will talk about to ordinary shareholders. So to ordinary shareholders. So to ordinary shareholders, they were receiving ordinary shares. So in which proportion? So in this case, we are told that this was whereby the ordinary shareholders of Tabu received 3 ordinary shares for every 5 shares in Tabu. For every 5 shares in Tabu, 3 for every 5. How many shares were there in Tabu? So you go to their balance sheet. So you go to the ordinary share capital, 5,000. That is the total capital. So per share is 10. So how many shares were there? 500. So it was 3 for every. That is 3 for every 5. 3 for every 5. So what about the 5? 500. So it's like saying here 3 for every. 3 for every is like 3 over 5. 3 for every 5. Times the 500. So it's the same way I have equated here. It's like 500 times 3 over 5. it's the same saying, 3 for every 5 times the 500 shares which were in tab. So these are the ordinary shares which tab received. But these ordinary shares were trading at what? Or they were given at what price? So there's something here they were trying to confuse the student, whereby they said that the shares from Fanaka were credited at 6. So that is the amount to use. Why not? Because our full market price was at 10. Because you can see from the start that is not why the authorized share capital. The authorized share capital of 750 was going at shillings 10. So our full market price of the shares, which Fanaka was giving out, they are supposed to be at 10. But now here, Fanaka has given out some shares and he has credited them at 6. So which means that there's a difference of 4. So where is this 4 going? So that is why they said the shareholders were to pay cash to Fanaka Limited to make the shares fully paid. To make the shares fully paid immediately on the receipt of the shares. So which means that now these ordinary shareholders again, these ordinary shareholders who were being paid by Fanaka here, when we will be going to the journal entries of Fanaka, it means that these ordinary shareholders in tab, they went ahead again to subscribe to the shares of Fanaka in order to make the shares fully paid. That is what they were trying to challenge you. And this is the same thing they challenged you in the last sitting, whoever did that paper. You never know. The KASNEB nowadays, they can even repeat external reconstruction. So it's better to be conversant. So the shareholders, that is why they have said the shareholders were to pay cash to Fanaka. Because now once you pay the cash to Fanaka, it means that they were giving out shares. So you have understood up that point. So for now, I'm not concerned with the difference of 4, but I'm concerned with how did Fanaka pay tab. He paid them ordinary shares, and those ordinary shares were credited at 6. So for now, I have to multiply by shilling 6. I have to multiply with 6. What are you getting? So this is 1,800. Then we go to the next one, the next additional information. The next additional information, number 3. The 10% preference shareholders of TAB received 4 ordinary shares. They received 4 ordinary shares in Fanaka for every 5 preference shares in TAB. So like now here, you know that TAB is the one who is being compensated. He received all ordinary shares. It's not the ordinary, but the preference shareholders are the one who are compensated in TAB for now. So we have said that the 10% preference shareholders in TAB, they received ordinary shares, 4 ordinary shares in Fanaka for every 5 preference shares in TAB. So these preference shareholders in TAB, they received ordinary shares from Fanaka. In which proportion? 4 for every 5 of the preference shares in TAB. 4 for every 5. How many preference shares were there in TAB? How many preference shares were there? You can see we have 10% preference share capital. The total value there is 2,500. So if you take 2,500, you divide by 10 per value, you get 250. So we go and do our recording. So we say that to 10% preference shareholders. To 10% preference shareholders. So this is all about, they were given ordinary shares. Remember, they received ordinary shares. In which proportion? 4 for every 5. It's like saying here 4 for every 5. So what about the 250? So it's like multiplying the 250. It's the same. So you get the ordinary shares they received. You get the ordinary shares they received from Fanaka. So each ordinary shares, we know that, was going at 10. But this one, was it credited at a certain value or it was at full market price? Was it credited at a certain value or was it at full market price?
Credited at 8 shillings.
So it was credited at 8. So we say that we record that. So if it was credited at 8, yes, they say that the ordinary shares from Fanaka were credited at 8. They were credited at 8. So we multiply with 8. So we say 4 divided by 5 times 250 times 8. We are getting 1600. So 1600. We continue to the next part. So the next area is number 4. Dividends on the 10% preference shares were 4 years in arrears as at 30th April 2015. Dividends on the 10% preference share were 4 years in arrears as at 30th April 2015. So first determine the one which are in arrears. So which dividends are in arrears here? Who can do that for me? It's just a direct thing. Because the dividends on the 10% preference shares were 4 years in arrears. So that is why I am heading back to this under equity. You take the contractual rate of 10%. Dividends will be paid on that 10%. The total value of the preference share capital is 2,500. So 10% of 2,500, that is 250. So 0.1 times 2,500, that is 250. So 250 are the dividends which were in arrears for 1 year. You multiply with 4 years. You multiply with 4 years. You get 1,000. You get 1,000. So this 1,000 was settled in which way? Fanaka settled them in which manner? They continued saying in note 4, the second sentence, Fanaka Limited accepted to settle the amount due by issuing 2 fully paid ordinary. 2 fully paid ordinary. So he paid 2 fully paid ordinary and 2 fully paid ordinary shares and shillings 100, 6% debenture, and the shillings 100, 6% debenture for every 2,000 of the dividends in arrears. So it was this way. So he gave out 2 ordinary and a shillings 10, a shillings 100, a shillings 100, a shillings 100 debenture, a shillings 100 debenture. So this is like 1 debenture going at 100. This ordinary which he gave out was at 10 shillings, because we know this one will be at full market price, because they have not told us that it will be credited at a certain value. Yes, so this one will be at full market price, the ordinary, because they never mentioned that they were credited at a certain value. They said for every 2,000 of the dividend arrears. So for every 2,000. So for this, for every 2,000 of the dividends, and for every 2,000 of the dividends. So you equate it this way. You say for every 2 ordinary is equals to 2,000 of the dividends in arrears. So what about the 1,000 which was in arrears? It's the same thing here. I've talked about 1 debenture. So for every 1 debenture of 100 shillings is equals to 2,000, is equals to 2,000. 1,000 of the dividends in arrears. What about the 1,000 which was in arrears? So that is how you equate. So you will come here and say that to preference shareholders again, to preference shareholders. So they were given ordinary shares. They are given ordinary. So ordinary shares in which proportion? 2 times 1,000 over 2,000. But this one, since they never mentioned they were credited at a certain value, we go with the full price, which they said was concerning the authorized share capital. So this was the full market price of any ordinary share. Full market price of any ordinary share which Fanaka was giving out. But where they have mentioned we credit with this price, we credit with that price. Like now here, the way they mentioned. Then the next thing here, remember that there was a debenture. So again, there was a debenture which the TAB received, and it was in terms of one debenture of 100 shillings. So we equated this way. So you take 1 times 1,000 divided by 2,000. So this debenture which they received, each debenture was going at shillings 100. Each debenture was going with shillings 100. So this one, even I can do it practically here. So this one goes with this. This goes with this, which means that I will remain with 10. So this is the way they were doing a long time ago when there was no calculators. So this one goes with that. Even this one. So this is a half. Half of 100 is 50. Half of 100 is 50. So we are done with that. We are done with that additional information. So the next additional information, they said in note 5, the debenture holders accepted 25 ordinary shares for every 500 of the debentures. The shares being credited at 8 each. So the debenture holders, again, they accepted to be given ordinary shares. So for every 25 ordinary, they were given. So they accepted 25 ordinary for every 500 of the debenture. But the ordinary which they received was credited at 8, whereby the balance, the debenture holders were to pay the cash to Fanaka Limited to make the shares fully paying. So I said right now, again, the providers of capital in TAB, right now the debenture holders, which means that they will go ahead to subscribe to those ordinary shareholders of Fanaka, and that one will affect our journal entries in the books of Fanaka. So for now, we are not concerned with that. For now, we need to know how Fanaka was paying the providers of capital in TAB. So like now here, he has paid the debenture holders by giving them ordinary shares. In which proportion? For every 25 ordinary, that is that is 25 ordinary for every 500 of the debenture, which were being credited at 8. That is what I need to record. So I would say to debenture holders, they received what? Ordinary shares. In which proportion? 25 for every 100. How many debentures were there in TAB? Debentures were 1,000. You can see from the balance sheet. 8% debenture, 1,000. 8% debenture, 1,000. And remember that this one was 6%. So I will come here and say to 8% debenture, to 8% debenture holders. So to 8% debenture holders. So they received ordinary shares. They received ordinary shares. So in which proportion? 25 for every 500. It's like saying 25 for every 500. Again, you can go ahead to do equations and so on. So you times the debentures which were in TAB So 25 for every 500. So it's like saying 25 for every 500. So what about the 1,000, which was in tab? So that is what I have done here. So this one, ordinary shares which they received were credited at 8. They were credited at 8. So 25 over 500 times 1,000 times 8. What are we getting? 400. That is fine. So this is the 400. So the last thing I would have to record here, the last thing I would have to record is concerning the last thing I would have to record is concerning that dissolution cost, because we say if the new company now pays dissolution cost for the old entity, that dissolution cost is supposed to be part of purchase consideration. So we were under note 5. Note 6 is all about the assets which were transferred to Fanaka. That one can never affect our purchase consideration. For note 7, this is now the case. Who paid this dissolution cost? Fanaka. So if the new entity pays dissolution cost, if the new entity pays dissolution cost for the old entities which is being sold, which is being taken over, that part of dissolution cost which is paid by the new entity will be part of a purchase consideration. So let us add, so 1800 plus 16 plus 10 plus 50 plus 400 plus 75. So I'm getting here 39, 35. Any questions so far, so good? So now let us prepare the relevant accounts which were now required to be prepared. So the first account I will start with is Fanaga account. So Fanaka account, this one will be able to show us on how he was paying Tabu. So this is what we have already done. So whereby you debit purchase consideration, whereby you debit purchase consideration. So purchase consideration was 39.35. You credit on how he settled that amount, how he made the amount of 39.35. How he made the amount of 39.35. So this amount was meant by ordinary shareholders being given ordinary shares, preference shareholders being given ordinary shares, you can see there. Preference shareholders again being given ordinary shares. Even 8% bench holders, they were given ordinary shares. So which means that you need to add those items and you credit with the ordinary shares. You credit to the ordinary shares. So the ordinary shares, will they receive? So in short, the ordinary shares which they received is 18. We have the next one 16. The third one being, this is from the purchase consideration. That is what I'm recording. 18, 16, 10. Then we have 400. Then we have debentures there, 6% debentures. So other than the ordinary, there is so 18, 16. And we have 10. And we have 400. Then there was that 6% debentures. So this one was 50. Then finally, there is this aspect of dissolution cost, which is cash book. So this is cash. So the cash was 75. This is what I have just recorded from the first purchase consideration we did. So this one you get 39, 35, 39, 35. So after that, you talk about ordinary sundry members account. So the balance brought down for ordinary. This is the balance brought down for ordinary share capital, that is. From the balance sheet. So we have the ordinary share capital account. There are 5,000. That is 5,000. So what did they receive from Fanaka? What did the tab receive from Fanaka? You go back to your purchase consideration. What did they receive? So you can see ordinary shareholders receive ordinary shares here. To ordinary shareholders, they received ordinary shares of 18. This one was to preference, this one is to preference, this is to debentures. So only ordinary received 1,800 of the ordinary share capital. So they received ordinary shares. So the ordinary shares was having a total value of 1,800. It was having a total value of 1,800. So other than that, what am I supposed to debit here? Other than what they received from Fanaka, you debit the assets which were never taken over by Fanaka. You debit the assets which were never taken over by Fanaka. So which assets were never taken over? So this one would be dictated by what you have in the note. In note what? In note 6. So these are the assets which were taken over. So which are the ones which were never taken over? So right now, if I start under the balance sheet here, building was the first one. Was it down there? It is taken over. You can see it's there in the additional information number 6. The next one is motor vehicle. It is there in note 6. It was taken over. I can see it. After that, we have goodwill. Is there goodwill in note 6? Is there goodwill in note 6? It was never taken over. Even if they said that it was presumed to have no value and therefore was written off, but now it was not taken over. That is what I mean. So we have to record goodwill at book value. This is one of the assets which was never taken over. So it was 875. It is 875. So that is goodwill. That is goodwill. Then the next asset maybe which was there. So if we continue with after goodwill, furniture and equipment. Is this there in note 6? It is there. Patent is there. I can see it in note 6. What about other assets like inventory and trade receivables? They were taken over. You can see them in note 6. So you compare what you have in the balance sheet of Tabu and what was taken over by Fanaka in the additional information. So the asset which will not be there in the additional information, it means that is the asset which was never taken over. And you debit under ordinary sundry members account. You debit it under the ordinary sundry members account. So this is sundry. Ordinary sundry members account. So after that, the only thing again you debit is concerning accumulated losses. You include the accumulated losses. So the entity has been retaining losses. So the retained profit we have is not a profit, but it's a loss. So even they have said accumulated losses. The accumulated losses. Sometimes they will call it a retained earnings in a but negative. So that is what you call accumulated losses. The entity, it was not doing well. It has been making losses. So that is why you can see it's an accumulated losses. That amount again you debit beside the assets taken over. So it's 21.25. Then on this side, you credit all of the reserves. Any reserve which was there, including share premium. Including share premium. All reserves including share premium. Which reserves are there? So you go to your equity part, there is no reserve, but I can see there's a share premium of 1,000. There's no another reserve, but there's a share premium of 1,000. Then up to that point, we can say that our balancing figure will go to the realization account. Our balancing figure goes to the realization. So this is 6,000. This is 6,000. Then 1,800 plus 875 plus 21.25 minus 6,000. So I'm getting 1,200. So after that, we continue to another account, which is preference now. Preference and members account. So the balance brought down was the balance brought down for the preference. You go to the balance sheet of tab. So this is the balance sheet. So preference share capital is 2,500 here, 2,500. Then there was, you increase this one by the preference dividends in arrears. So remember that in arrears, we took 10% of 250, but it was in arrears for 4 years. This one we got 1,000. We got 1,000. So this arrears itself goes to realization. You close it to realization. The one which are in arrears, you close them to realization. Then here you debit what they received from Fanaka. So in order to reduce what they were claiming, what they received from Fanaka. So what they received from Fanaka is all about, you check on what we have already done in our purchase consideration. So you can see like now, we have there this one to preference. So there's ordinary they received. And again, there's this to preference. Remember, on this scenario, they were paying these dividends which were in arrears, whereby they were given ordinary shares again, and they were provided with 6% debenture. So that is what we debit. So we debit this, and also this debenture. So ordinary day is 1,600 plus 10, that is 1,610. Then 6% debenture is 50. So there's this ordinary of 1,610, because it's 1,600 plus the 10. Then we have 6% debenture. So the 6% debenture was that of 50. It was that of 50. So up to that point, the balancing figure goes to realization. So which is the balancing figure? So remember, this is 3,500. That is 3,500. This is 3,500. So to realization, so 1660, because 1610 is all about 1660 minus 3,500. So this is 1840. Yeah? That is 1840. Then after you are done with preference, you do the debentures account. You do the debentures account. So the debentures account balance brought down for the debentures. So you check from the statement of a tab, that is the balance sheet. 8% debenture, 1,000. It was 1,000. It was 1,000. So this is 1,000. So from who? From Fanaka, they received what? So you go to your purchase consideration you have done. So you can see the last thing we did here. They said that to 8% debenture holders, they received ordinary. To 8% debenture, to 8% debenture holders, they received ordinary of 400. So that is ordinary shares. So the total value there was 400. The total value there was 400. So which means here to realization, that is so this one would be 1,000 and this one would be 1,000. So this is 600. That is 600. Then after this, we can do cash book. So cash book balance brought down. Was there a balance brought down for cash book? You go to your balance sheet. You give me the balance brought down if it was there. Was there a balance brought down? So if we check on this balance sheet under cash, under current assets, there is no cash. You can see there is only inventory and the trade receivables. So this one is not there. So the only cash they received is the one which they received from Fanaka. The one they received from Fanaka, the 75, which was behaving as a distribution cost. So this one is the one I would say to realization account. So the 75, so that we can close this at 75, at 75. So once we are done with the first account, this now, every account here you have been seeing that I've been saying the balancing figure goes to realization. So which means that I have to close everything now from this account to realization. And at the same time, I have to close my assets, which were taken over, the assets of tab, which were taken over by Fanaka. So because now in the old company, we have to close them by crediting the individual assets, we debit realization. Then for the liabilities, you debit the individual liability account, you credit realization. But on this scenario, you know that we are not preparing individual assets and liabilities account. So what I will do, for the assets which were taken over, I have to debit under realization with their book value with the same liabilities. Liabilities I will credit under realization with their book values. And again, from these accounts, what I have been saying that we close to realization, we have to close it to realization. Including even this purchase consideration, which I never mentioned that we close it to realization, this one. So that purchase consideration will be closed to realization. So let us do the realization account. Then we can move now to the channel entries of the new entity. So realization account. So I have said I debit all the assets because now if you are preparing individual asset account, in order to close this, you credit. the individual asset account, then you debit realization. So we check the assets which were taken over, we debit, but with their book values. Because now in the tab, they were recorded at book values. Never record with the figures of Fanaka, because the figures at which Fanaka took them would be recorded in the balance sheet of Fanaka. So this is note 6, and this is where the assets were transferred to Fanaka. So the asset is building, motor vehicle. So these are the ones I debit, but I will never debit with these figures which are here. I will debit with my book values, with my book values in tab, because we are closing those assets which were taken over by Fanaka at their book values. So note 6 will just guide us which assets were taken over. Which assets were taken over. So I will just debit building. So there's building, there's motor vehicle, there's this furniture, and there's this furniture and equipment thing. There's this thing called patents. There's this thing called inventories. There's this thing called receivables. So once I have copied them that way, I will now, so I have recorded them that way there under the debit side without the figures. So the figures now which I record is the one which are in the book value. The book value, I mean the one in the balance sheet. So for building, it was, for building 2050, for motor vehicle 17, furniture and equipment 1087.5, we have 462.5, we have 950, and we have 462.5. So that is what I have done. So I have recorded with their book value. I have recorded that with their book value. Then after that, even the liabilities, obviously they must be taken over. They cannot take over assets, they review with the liabilities. Even if they never mention, I think there's nowhere they mentioned that the liabilities were transferred. But an entity cannot buy you with only assets and review with liabilities, which means that even liabilities we have to close from the books of the tab, so that we see that and that one are closed. So the one which are there, the liabilities, you can see we have a current liabilities, that is a bank overdraft and trade payables. Bank overdraft and trade payables. So this one, you credit them because now under individual liability account, they have been debited to close them. So 75 and 375. So bank overdraft and payables. Bank overdraft, I would say bank OD overdraft 75, and the payables 375. So after you are done with that, you go back to your account now. The first account was having a Fanaka. So we said purchase consideration is the one which we close to realization. So it was on the debit side. We credit here. What about the next account? Ordinary sundry members account. So ordinary sundry members account, the balancing figure is 1200 on the debit side. So we credit ordinary sundry members account. So that is 1200. Then after that, the third account was preference. Our third account was preference. So this is and we have the one which is under the here, and the one which was in arrears. So the one which was in arrears, we debit because it was on the credit. So preference dividend in arrears. So the preference dividends in arrears, which is 1,000. Then we have now the one which was the balancing figure. So preference sundry. So the 1840. Then for debentures, for the debentures account, it was on the debit, this one. So we credit debentures. So the 600, you can see here, to realization was 600. Then finally, my cash book, we have 75 on the credit side. So we debit that. So up to that point, we are done with this account, and it's supposed to balance automatically. So try balancing that. So 2050 plus 1700 plus 1085.5 plus 462.5 plus 950 plus 462.5 plus 1000 plus 75. Which total are you getting?
8025.
So 8025. So maybe there's something in my calculator I ignored. And so that is 8025. And the credit side?
The same.
Oh, it's the same, 8025. And so that is fine. So after we are done with that, it means that we are done with the first requirement. We are done with the first requirement. So the next requirement was concerning what? We do the channel entries, and that is now the part which is a bit wide enough, which needed a bit of time. But it's all understanding debit and credit. So it is another 8 marks. So you have the 8 marks first, but it's not a must that you do all the accounts I have done to get 8 marks. The mark entries, they can decide to give you half for every correct entry you did in every account. So you can even do 3 accounts you are done under the first one. You can do even ordinary, preference, and even debenture. You could find that you are done with that 8 marks. Then for journal entries in the books of Fanaka to record the acquisition, so let us do that. So journal entries, we have to do debits and credits. So journal entries, so we have debits and credits. So remember that this is in the books of who? The journal entries we are doing is in the books of Fanaka. So remember that we have closed tab. We have closed the tab. So now we are opening Fanaka. Fanaka was the purchasing entity. Was the purchasing entity. He was the purchaser. So the first thing we recognize is on how he paid. The amount he paid the providers of capital in Fanaka, in tab, that is. So Fanaka, what he paid in tab, it was how much? 39.35. So this was the 39.35. So that it was the entity who was purchasing tab. So in order to recognize that 39.35, we debit business purchase account. So you debit business purchase account. So the business purchase account. So the business purchase account, that is 39.35. Then you credit the tab. You credit the tab limited. 39.35. So we will say to record purchase consideration, to record or to recognize. It's either. But now this amount was paid in which way? So after you recognized by debiting business purchase account and crediting the company which was paying, now it was settled in this way. So you come and debit tab 3935. So they were given what? They were provided with what? They were given this total of ordinary shares which they received was. So remember that they received ordinary shares. They received ordinary shares. They received ordinary 6% debenture and ordinary. So add the 1800 plus 16 plus ordinary again we have 10. Then we have 400 another ordinary there. So we have an ordinary which they received 3810. So I have just added these ordinaries they were given. So then there's debenture which I will record here, and there's this cash of 75. So they were given ordinary of total value of 3810. Then there was that 6% debenture. So the 6% debenture was 50. And there was that cash of 75 to behave like a dissolution cost. So this one, we would say on settlement of purchase consideration. On settlement of the purchase consideration. On settlement of the purchase consideration. So after that, the third thing you record is the assets which were taken over. Now, according to the new figures at which Fanaka took them, that is under note 6. Under note 6, he took what and what? He took building, motor figures. So those you debit, assets are debited. You debit with those figures. So buildings 1550. So you debit. Motor vehicle you debit with the new figures now, the way they were taken over 1375. Furniture and equipment. So you debit the 1075. Patents, the way it is there. So 350. Then we have inventories. So inventory is 700. Then final receivables. We have the receivables. Those are the assets, the way they were taken over now, you debit. Remember, under realization, I was debiting them with the book values of tab. But now remember here, we are preparing the journal entries of Fanaka. So the way I have debited them there. Then I credit now business purchase account. So add the figures, then you credit 1550 plus 1375. Give me the total if you have done already.
5675.
56?
75.
5675. So that is to record. You will narrate and say to record the assets. Record the assets on acquisition. To record the assets on acquisition. To record the assets on acquisition of tab. Then after we are done with that, we continue now to the liabilities. So debits and credit. debits and credits. So the liabilities, I remember it was just two of them, bank overdraft and so you debit this one are credited. So you debit business purchase account, business purchase account with what? With those bank overdraft. They were bank overdraft and the payables, trade payables. So this one was 75 and this one was 375. These are the two of them. So if you add the two, 75 plus 375, that is 450. So to record liabilities, taken over. To record the liabilities taken over. After that, we have to check if there's goodwill, or if there's no goodwill, there's what? Capital reserve. So how do you get goodwill, guys? How do you get goodwill?
Purchase consideration less net assets.
So purchase consideration on this scenario was 39.35. You minus our net assets, the assets which were taken over here. So this is the purchase consideration. So for the assets, the total assets which were taken over is 56.75. Liabilities is 450. So you take these assets minus liabilities, then you take your purchase consideration minus now the total you arrived at. It means 39.35 minus 56.75, which is an asset. So minus a liability of 450. So I close the brackets. I'm putting the two in brackets because I have to subtract assets minus liabilities, then minus the purchase consideration. So you can see it's a negative of 1290. So that is not a goodwill, but we call it a capital reserve when it comes a negative. That is a capital reserve. So capital reserves you credit, you debit business purchase account. So if it's goodwill, you debit, you credit business purchase account. So this was capital reserve. So you debit business purchase account, that is 1290. Then you credit capital reserve, the 1290. So if it was goodwill, I could have debited goodwill because goodwill is an asset. Then I credit business purchase account. So this one is to record capital reserve, to record capital reserve on acquisition of tab. So our previous questions, they were up to that stage. But now in this question, there was an extended stage now. That is why I did this question. There's an extended stage. Which is this extended stage now? It's a continuation anyway. It's not a new thing I have to do. It's a continuation. Which new thing will I have to record here? Who can try? Which channel entries have I not recorded? That is what I'm saying. In Fanaka.
Cash book.
Which one?
The one we credited at 6.
Yes, the one we credited. The first one was the one which we credited at 6. So why am I doing that? Rowan, why are we doing that, cash?
To make them fully paid.
So so right now note 2, who are being settled in note 2? Who are being paid in note 2? In note 2, they say that ordinary shareholders of TAB received ordinary shares in Fanaka. So they received ordinary shares. So 3 ordinary shares for every 5. So the shares of Fanaka were credited at 6. And we know any ordinary shares which Fanaka was supposed to give out was supposed to be at 10. So it has issued for now at 6. So what about these 4? The difference of 10 and 6. So they went ahead to say that the shareholders were to pay cash. So which means that these shareholders who were being paid in tab, the ordinary shareholders, they were to pay cash to Fanaka. So which means that these ordinary shareholders again in tab went ahead to subscribe to the ordinary shares in Fanaka. That is why they were paying cash to Fanaka to make the shares fully paid immediately on the receipt of the shares. So you will use the proportion, everything will be there, but you multiply now with 4. So the proportion will be, remember that they were receiving ordinary shares in this proportion 3 for every 5. So you check how many ordinary shares were there in Tabu. The ordinary shares which were there, I think we said it was 500 because we have 5,000 divided by 10. Then now you multiply with 4. But that is how they were subscribing to the shares of Fanaka, which means that Fanaka will receive cash. So we debit cash. So cash. So in the proportion of that proportion at which they were receiving the shares, which means that the proportion at which the ordinary shareholders in Tab again, they were receiving shares was in 3 to 5 for every 500 of the shares in Fanaka. But now it is at shillings 4. So remember that for Fanaka to make this cash, it was doing what? It was giving out ordinary shares. As told in that note too, it was giving them ordinary shares. So that is this is 1,200 and this is 1,200. So you say on receipt of part 3 paid shares. On receipt of part 3 paid shares. So the same to other additional informations whereby it has been credited at a certain value. So where it has been credited at a certain figure, where is this again? So note what? Note the 3, it was again credited at 8 because even note the 3 you can see the preference shareholders in Tab, they were receiving what? Ordinary shares in Fanaka. So 4 ordinary for every 5 preference. So this ordinary which they were receiving from Fanaka, they were credited at 8, and the shareholders were to pay cash to Fanaka to make the shares fully paid immediately on the receipt of shares. So again, they were receiving ordinary. So again, which means that to make them fully paid, these preference shareholders in Tabu, they were subscribing to the ordinary shares which they received at now shillings 2. But in which proportion? 4 ordinary for every 5 preference. How many preference were here? How many preference were in Tabu? 2,500 divided by 10, 250. So which means that again we debit cash, but now with the same proportion there. So it was which proportion? 4 for every 5 times 250 of the preference shares. So you multiply now with shillings 2. You multiply with shillings 2. So in order for Fanaka to receive cash of this kind, remember that it was giving out ordinary shares. That is why we have debited cash which he received due to the ordinary shares he was giving out. So 4 for every 5 times 250 times 2. So this is 400 and this is 400. So again, I would say on receipt of part 3 paid, on the receipt of part 3 paid shares. So after that, we need to check another which is remaining. So another thing which is here is concerning. So we have done note 203. Note 4, note 4, note 4, note 4. These ordinary shares which they gave out was at full market price, because they never mentioned that they were credited at any figure, because they say dividends on the 10% preference shares were 4 years in arrears. Fanaka accepted to settle the amount due by issuing 2 fully paid ordinary. So you can say they said that 2 fully paid, which means that they were at 10, the 10 shilling. Note 5, the debenture holders accepted 25 ordinary for every 500 of the debentures. So the shares being credited at shillings 8. So remember that the debenture holders again received ordinary shares, which were credited at 8. So what about this balance? They continued saying the debenture holders were to pay cash. So you see, it's like now they are again subscribing to the ordinary shares which they received from Fanaka by paying cash to Fanaka to make the shares fully paid on the receipt of the share. So again, we have to record the cash which Fanaka received. So the proportion was 25 ordinary for every 500. So the debentures were 1,000, but now we have to multiply with 2. So 25 over 500 times 1,000 times 2. So that is the cash. So 25. So it was 25 ordinary for every 500 of the debenture. So the debenture were 1,000 times now shillings 2, because it was created at 8. So this is all about the ordinary shares. Ordinary shares which Fanaka gave out to the debenture holders. So 25 you divide with 500 times 1,000 times 2. What are you getting? So this is supposed to be 100 and this is 100. So that is 100 and that is 100. So this is again on the receipt. On the receipt of a part 3, paid shares. On the receipt of part 3, paid shares. So after that, we move to the next thing, debits and credits. So what is remaining? So are we done with the credits I was talking about? We are done with that. But now there's this normal, again, double entry, which is supposed to be done. There's this double entry, a normal one, which is supposed to be done. This double entry, which is a normal one. Number 8, immediately after acquiring Tabu, Fanaka purchased trading stock worth 150 in cash and they settled 125 of the trade payable. So there's 2 things here. You have to record the trading stock, and again you have to record the payables. So what am I supposed to do? Well, this is just now the normal knowledge, in debiting and crediting. Yes, Mwaniki, Elizabeth. What am I, Mwaniki and Elizabeth? What am I supposed to do? Like now under trading stock. So if a trading stock was purchased, what would I do? So let's say, for example, you purchase the stock now. Which account do you adjust? So Rogin, what accounts do you adjust? Which accounts do you adjust? They say you have purchased the stock today. So you debit. See, stock has increased. When you purchase stock, you debit your inventory account. You debit your inventory because this is an asset account. Then we paid cash. See, there's money out. You credit your cash account. Then you narrate and say on purchase of inventory. On purchase of inventory. On purchase of inventory. What about for payables they paid? Now try that. There's nobody who can try that one. They paid payables. What would I do to the payables? Would I debit or would I credit? Payables, one is paid because payable is obvious. That account, it's a liability. It's a liability item. Eh? So liabilities are credited. So if it's paid, we debit. We debit the payables at 125. So it was paid in terms of what? Cash, 125. So on part, because payable was, it was not just 125, it was more because it was around, if you go to your balance sheet, it was not just 125. That is why I'm saying on part payment of the payables. Payables was 375. It was 375. It's only that part of it was settled. 125 was settled. So that is why I'm giving a narration by saying that on part payment, on the part payment of payables, on part payment of the payables. You need to understand these credits and debits. You need to understand these aspects of debits and credits. So for you to do this well, you need to understand that debits and credits. And this one was the relevant thing I shared to you, debit and credit. The term debit indicates the left side, and the credit indicates the right side of an account. What is an account? An account has three parts: a title, a left or debit side, a right or credit side. So a left side is a debit side. A right side is a credit. This is an account. You can see that. It has a left side and a right side. A common thought. So there's this aspect, yes. We always use that to make students anyway understand, but that is not the truth. Debit, credit never mean increase or decrease. But we use them to make you at least understand what we always say. But it doesn't mean increase or decrease. What is debiting and crediting? So entering an account on the left side of an account is called debiting. When you enter an amount on the left side of an account is called debiting. Entering an amount on the right side of an account is called crediting. What is debit balance? What is credit balance? So when totals of debit amount exceed the credit amount, that is a debit balance. When the total of the debit exceeds credit. What about the credit balance? When the total amount of the credit amount exceeds the debit. And this is the equation. You will go and read this. It is in your WhatsApp group. So you can see there's a plus, you debit under assets, then a minus, you credit. So like now, we are not supposed to say that a common thought that when an asset account increases, it's debited. We are supposed to say that what you enter on the debit side on this account, that is what you are supposed to know. So go through this. This one will assist you to understand that aspect of debits and credits as we do more of the questions again. So that was just by the way. You have it. You have this slide. So let's continue now to the final part of the question. That is the presentation of the statement of financial position. That one was just a copy-paste work. So now we do the Fanaka. The Fanaka Limited. So it's an opening statement. Because now in the next financial year, the statement will be different from what we have. So that's why I'm calling it opening financial statement. As at what? So our previous financial year was ending at what? Our previous financial year. So our previous financial year was ending as at it was ending as at what period?
April, 30th April.
So it was ending as at 30th April. So which means that in the next financial year, it will be starting on
1st May.
1st May. It will be 1st May 2015. 1st May 2015. So now for the assets to record, are the one which were taken over by Fanaka. And these are the assets which will be taken over by Fanaka. So the way they were taken over here, that is what to record. So you record the way they are. So if it's non-current asset, you record this, and this one, and even patents. So for the current assets, we have inventory and receivables. Then you consider under the current asset, there is that cash they were generating through the issue of what? Shares. Through the issue of shares. So let us record those assets. The way they are, a building, you record that, motor vehicle, furniture, patents. So record as non-current assets under your balance sheet. So we have the building. So 1550. We have the motor vehicle. So that one you are supposed to record them under non-current assets. So 1375. We have the furniture. We have the furniture and the fittings. So the furniture and the fittings is, it is furniture and the fittings or equipment. So that is a 1075. There was that patent, that is according to note 6, 350. So you go to the current assets. So current assets, you can see there was inventory in that note 6. Inventory was, so for inventory, there's something I need to add there because there was an inventory they purchased. There's an inventory they purchased. So other than the inventory, which is just here, 700, there's another one which was purchased down here. Yeah, so in note 8, immediately after acquiring Tabu, Fanaka purchased trading stock of 150. So that one will be added to the one where they took over, the 700. So that one will be 850. So 700 plus 150, so it will be 850. So next we have receivables. So for the receivables, that one there's nothing to add there. You record direct 625. Then I said you will have some cash. You will have to have some cash from what we have been doing. From what we have been doing in the journal entries. So in these journal entries we did, remember that on the subscription of the shares, we shareholders of Tabu were making in Fanaka. So Fanaka was receiving a cash of 1,200. Like now you can see on the debit side. He received that. There's this 400 again he received. Then again, there's this 100 down there. There's this 100 here, which he received. So you take 1,200 plus 400 plus 100. So 1,200 plus 400 plus 100. Then was there any cash they paid out? Yes, they paid payables part 3. They paid trade payables part 3, and even stock. When they purchased the stock, they paid for it. So they paid this 150, and when they were paying payables, they paid 125. 125. So that one was going out. So we subtract. So 150 minus 125. Again, you minus 75, the overdraft. You minus the 75, which is the overdraft. So 1,200 plus the 400 plus 100 minus 150 minus 125 minus 75. That is 1,350. So this is 1,350. So total assets. So then we have ordinary. That is under equity. So this is equity and liabilities. For equity and liabilities, we have the ordinary share capital. So ordinary share capital, remember the one you record is just what we did already on how Fanaka was paying the providers of capital in tab. So then under journal entries, the second journal entry we did. So he settled this, whereby he gave out these ordinary shares. This is what we record here. So, and you know how we arrived at this? You know how we arrived at that at 3810. Arriving at 3810, we took 1,800 plus 16 plus the 10 plus the 400. So that is the first 3810. Then we have to add. Remember again, there was a capital which was due to the shares which was subscribed by the providers of capital in tab. The one which we are saying that to make the shares fully paid. So that one was subscription of the shares which some of the providers of capital in tab were making. So like now here, they purchased these 1,200 shares. They purchased this. That is why the entity received the cash. That is why they received the cash. Because these providers of capital were purchasing shares. They were purchasing shares. So these are the shares which were purchasing. So 1,200 plus 400 plus 100. 1,200 plus 400 plus 100. So we add that one to the 3810. So 3810 plus 1,200 plus 400 plus 100. So that one I'm getting 5510. Then remember there was a capital reserve. When we were checking if there was goodwill, we got a capital reserve. There was no goodwill, but there was a capital reserve. So our capital reserve was I think we did this 1,290 because we took the purchase consideration minus net assets. Net assets is assets minus liabilities. So we got 1,290. Then we come and talk about non-current liabilities. So for the non-current liabilities, again, you go back to your second channel entry. When he was settling again this 39, 35, he gave out a 6% debenture of 50. And the debenture, you know, is a long-term liability. Then finally, we have the current liabilities. So under the current liabilities, there is this bank overdraft. So the 75. Then we have the payables. So we have the 375. Then there was an amount which was paid, part of the bank overdraft, not part of the bank overdraft, part of the payables was paid, and that was in note 8. You can check that note 8. It was 125. So this 125 was paid. So 375 minus 125 minus 125. So the balance is 250. So this is the bank overdraft. So this is not a bank overdraft. This one is that cash which was given out. This was a dissolution of cost, which was given out, by this Fanaka to tab. So balance this question. Balance the question. So balance the question. So 1550 plus 1375 plus 1075 plus 350 plus 850 plus 625 plus 1350. 5510 plus 1290 plus 50 plus 75 plus 250. So you can see it's balancing. It's in agreement. 71, 75. And that is how you were supposed to do the question. And that one marks the end of the session today.